In a world that worships spectacle, Jeff Yass built his fortune in silence. He never sought the glare of talk shows or magazine covers. His fingerprints are on markets, political battles, and technology deals that shape outcomes for millions. Yet he moves like a shadow, precise, deliberate, almost surgical. This is the story of how a quiet strategist turned an obsession with probability into one of the most consequential fortunes of a generation. Origins of an analyst. Jeffrey S. Yass grew up in Queens, New York, in an environment that taught him to pay attention to patterns. As a boy, he watched numbers the way other kids watch sports scores. He was drawn less to winning in the moment and more to understanding why outcomes occurred. That curiosity led him to mathematics and economics at SUNY Binghamton, and later to graduate study at NYU. But the classroom was only the beginning. The real training ground was the poker table and the racetrack, places where odds are revealed in cold, relentless detail. At those tables, he honed something rarer than luck: temperament. He learned to separate emotion from action, to treat losses as data, and to turn patience into advantage. Each hand, each race was an experiment. Each experiment, a lesson in expected value. He learned that success was often less about predicting the future than about correctly sizing bets against probabilities. From games to markets, the transition from card rooms to trading floors was logical for someone who thought in terms of edges. In the early 1980s, Yass joined forces with fellow analytically minded partners, people who, like him, prized cold calculation over narrative. Together, they founded Susquehanna International Group. The name was local, but the mission was revolutionary: apply game theory and rigorous statistical analysis to financial markets. SIG wasn't a traditional firm. It eschewed the celebrity traders and loud media personas that dominated Wall Street lore. Instead, it built training programs that looked like boot camps for the intellect. New hires were tested on puzzles and probability problems rather than resumes. The firm recruited chess champions, poker professionals, and math competitors. People who understood how to think under pressure, how to model uncertainty, and how to convert tiny edges into consistent returns. This approach changed the game. Where most trading relied on intuition, rumor, or momentum, SIG built systems that priced risk with the exactness of an instrument. Algorithms, proprietary models, and disciplined traders combined to discover inefficiencies other market participants overlooked. Small advantages leveraged repeatedly compounded into outsized results. The anatomy of an edge. Yass's worldview was deceptively simple: treat every decision like a bet, compute the expected value, and act when the math favored you. That framework applied across contexts. On a trading desk, it meant quantifying volatility in option prices. In venture decisions, it meant sizing downside against speculative upside. In political spending, it meant allocating resources where influence yielded measurable policy shifts. He built a culture that rewarded precision. Mistakes were tolerated as part of learning, so long as they were recorded, analyzed, and corrected. The firm's playbook was less about ego and more about feedback loops. When a model failed, it failed fast and was refitted. When an approach worked, it was scaled. This relentless refinement turned small informational advantages into structural dominance across options markets, TFS, and derivatives. SIG's growth was not ostentatious, it was methodical. The firm invested in execution speed, in low-latency communication, and in hiring people who could think probabilistically under stress. It created a feedback-first training environment where every trader was also a student of statistics. The result was a machine that profited not from single brilliant trades, but from disciplined repetition of marginal edges. Money, power, and secrecy. As wealth accumulated, Yass avoided the public trappings many billionaires embrace. He invested, donated, and influenced, but he did so without celebrity. That discretion amplified his power. Attention is a currency, and by spending none of it, he preserved strategic surprise. His financial footprint extended beyond trading. SIG's capital and expertise flowed into venture investments, private deals, and strategic stakes in global tech companies. One of the most striking moves was an early position in ByteDance, the parent company of TikTok. To outsiders, it was an eyebrow-raising stake. A private investor deeply tied to high-frequency trading, placing a meaningful bet on social media. To Yass, it was a rational allocation, a high-growth platform with global reach, an asymmetric payoff compared to the risk. The ByteDance investment exemplified his approach. Place well-priced bets in arenas where information asymmetries and momentum could be modeled, then let disciplined sizing and patient holding convert volatility into value. Political calculus. If Yass's trading philosophy was probabilistic, his political engagement was strategic allocation. His donations and political underwriting were not acts of self-promotion, but calculated efforts to shape public policy outcomes aligned with his worldview. Smaller government, school choice, lower taxes, and market-friendly regulation. He funneled significant sums into campaigns, ballot initiatives, and independent expenditure groups, amplifying voices that would move policy in directions favorable to market-oriented solutions. Those moves stirred controversy, particularly as the scale became public. Critics argued that concentrated wealth could unduly influence democratic processes. Supporters argued he was exercising a right by backing ideas he believed in. For Yass, the debate was another decision matrix. Weigh the policy outcomes, estimate the leverage of dollars expended, and act where the expected value of influence justified the cost. His political funding was notable for its stealth and scale. Instead of headline-grabbing rallies, he used targeted contributions, think tanks, and local initiatives. The tactic was efficient. Influence, after all, is less about spectacle than about outcomes that stack in your favor over time. Crisis as opportunity. Markets offer moments that reveal a strategist's mettle. When crises arrive, the crowd panics, stories proliferate, and prices misalign. Yass's discipline turns such times into opportunities. During the dot-com bust, the 2008 financial collapse, and other sudden market dislocations, SIG's systems kept running. Where others liquidated in fear, SIG often found edges born of mispricing. This wasn't recklessness. It was the application of the same rule he'd learned at tables and racetracks. Identify the probability structure, calculate the expected value, and then size the bet to withstand variance. In volatile markets, the ability to commit capital where others cannot becomes a formidable advantage. As banks retrenched and retail investors panicked, a well-structured player with access to capital could buy mispriced risk and harvest returns when markets normalized. Culture and recruitment. One of Yass's lasting innovations was building a culture that translated intellectual gamesmanship into financial performance. SIG became a destination for unconventional talent. The recruitment process weeded out those drawn to glamour and rewarded those drawn to puzzles. Onboarding was rigorous. New hires faced simulations that mirrored real market stress and probabilistic uncertainty. The point was not to create robotic traders, but to forge disciplined thinkers who treated volatility as data rather than drama. Mentorship at SIG resembled apprenticeship, not classroom lecturing. Senior traders mentored juniors through iterative problem solving, emphasizing post-trade analysis and cognitive humility. The firm's systems codified knowledge, but the human element, the ability to update beliefs based on new evidence, remained central. That combination of human judgment and algorithmic speed produced a persistent advantage. The personal side. Outside finance, Yass kept a low public profile. His lifestyle did not demand public adulation. Benefits were accrual rather than applause. Friends and colleagues describe him as intensely private, analytical in conversation, and impatient with rhetorical flourish. He preferred decisions backed by models to pronouncements broadcast for effect. That temperament served both his business and personal life. Privacy protected him from the noise of fame. Focus allowed him to iterate on strategies without distraction. He invested in causes and institutions quietly, but with significant impact, shaping education policy, supporting research, and backing entrepreneurship in ways that aligned with his probabilistic worldview. Lessons in edge. What makes Yass's story resonant is not just the wealth, but the method. The lessons are practical rather than inspirational. Cultivate intellectual rigor, convert curiosity into repeatable processes, treat setbacks as information, and use disciplined sizing to survive variance. In a world awash with opinion, his is a testament to systematic thinking. His life also exposes tensions. The concentration of power that follows financial success, the ethical questions raised by large-scale political donations, and the opacity of private influence. Those are real debates, and they complicate any simplistic hero narrative. Still, from a purely strategic lens, Yass's approach converted probabilistic thinking into outsized influence. The quiet continuing. Jeff Yass's empire did not rest on an early lucky strike. It was assembled iteratively through recrudescent refinement of models, hiring, and disciplined capital allocation. Where flashes and headlines create illusions of mastery, his success came from doing the unglamorous arithmetic of advantage, finding small mispricings, training humans to exploit them, and scaling those edges patiently. He remains emblematic of a class of modern financiers who prize systems over stories and who understand that compounding advantage is often an unglamorous process of repetition and correction. Whether in trading, tech investments, or political influence, his moves reflect a worldview built on numbers, not narratives. In the end, Jeff Yass's story is less about glamour and more about a mindset, a conviction that careful measurement, disciplined risk-taking, and endless iteration produce outcomes that headline-driven actors cannot match. It is a reminder that in markets, as in life, power often accrues to those who can calculate better than they feel and who can wait patiently for the probabilistic ink to dry.